wanted me to deliberate on alternate lending models in India. Huh?
How you can
So
boost this flyover to
yeah,
the
absolutely,
SMEs?
absolutely. See,
Yes.
basically what is happening, the traditional lending model does not fill the appetite for the MS sector. Almost there are more than 8 crore business enterprises sectors in India, which is providing employment to almost 11 crore people in India. This sector contributes approximately 90% of the manufacturing output in the economy, along with significant share in revenue generation for service sectors. However, despite the contribution to the economy, the sector has remained largely underserved by the banking sector and by the financial sectors. The existing gap in the availability of funds to SME and other government on increasing credit flow to this agreement has put digital SME lending in the sweet spot right now. And probably most of the fintech companies are working for an alternative mode of lending to SME sectors. What are the limitations to the conventional credit underwriting models now? What exactly, why alternate model is required? The funding challenges for SMEs stems from banks and financial institutions have found it a task to assess the credit worthiness, choosing only to fund enterprises that have a good civil score, detailed audited balance sheets, financial statements, and have an asset as a collateral. These are the basic fundamental, the tools which the banks and financial institutions are following to lend to the SME sectors. But what we have seen is number of companies do not meet this criteria, or even if they meet the criteria is very low. As such, the banking sectors are not able to fund these institutes, these SME sectors and the demands, and the appetite remain unattended. In past, few microfinance companies, NBFC have stepped in to fill up this gap by some innovative lending procedures. But still, what I personally feel, they to some extent they were able to give the credit flows to the SME sectors, but not what is required for these sectors. So the fintech companies, they started working on these models, and the alternate credit scoring based on digital data gives the lender a more holistic view of borrower's creditworthiness and associated risk for credit underwriting. Fintech lenders are using different non-traditional data source to determine a borrower creditworthiness and repayment ability, along with a mix of conventional data points on the enterprise financial performance, such as sales, revenue, income tax return, GST data, book of accounts, latest cash flow statements, and outstanding invoices. So these are the data which normally the bankers did not have any access, or had access but to a limited extent. And even then, they did not have the proper business tool, analytical tool to process the data points which I have just spoken to create a intelligent decision making tool. So now the fintech companies have come in. Now they are now new such transaction data, point of sale information, surrogate data like utility bill payments given a granular view of the business. This model has largely been pioneered by fintech companies. These companies provide digital sourcing platform, run the alternate data scoring engines, partner with various banks and NBFCs to offer various lending products. So most of the banks now are now going for alternate lending systems, because the traditional system does not support their credit underwriting engine. So deployment credit underwriting mechanism powered by advanced technologies such as artificial intelligence, machine learning, and data analytics, a massive volume of data from various disparate sources can be compiled and analyzed extensively with the help of algorithm to derive this useful insight. Each data point can be treated as a variable of credit appraisal and can be assigned a specific weightage depending on the nature of business within the overall MSME segment. The resulting credit score are then used by the lenders to take decision pertaining to the financing of loans, such as assigning interest rates, quantum of loan, deciding on repayment terms and timelines. Data analytics, machine learning, and automation provides a strong foundation for new age credit underwriting models employed by fintech lenders, ensuring faster, much better access to credit for MSME located even in the tier 3 and tier 4 cities town in India. The tech-driven financial service, the marketplaces are facilitating access not just to lending, but also the whole different range of financial management and investment services for MSME and connecting them to the capital market as well as institutional investors who want to contribute their growth. The marketplace, now the consumers, the borrowers can online apply for their loan, and all the data are compiled online, and the decision making modeling helping the bankers, the lender, the financial institution, the NBFCs to take a decisions. So these methods, I can talk with one of the latest model which I have seen right now. It is with the one company is running with the in collaboration with the Industrial Bank, wherein what they are doing, they have derived algorithm wherein the borrower is supposed to work in that algorithm, that app, and immediately the bank gives them 50 lakhs of loans, minimum 50 lakhs of loans immediately given. What happens in this whole modeling? The whole in the payments and the receipts of the company are routed through this app only. He can't route the app. The buying and the selling are done through the app, and the bank knows exactly how what is the health of the company. So this is how the things are happening, and immediately things are the loans are being disbursed. So alternate decision model, I think in coming days is going to be a big changer in the financing to MSME sectors.